On August 15, 1969, a group of legal experts completed a framework that would shape what happens to a person's assets after death. It became known as the Uniform Probate Code. Hidden within Article 6 is a rule that many Americans still fail to fully understand. You may have a carefully written will stored inside a fire-resistant safe. You may have paid an experienced attorney to prepare a trust. Your children may know exactly where every document and key is located. But when the bank receives notice of your death, those preparations may not be what determines immediate access to the money in your account. The bank employee looking at your account is searching for something very specific, a legal beneficiary designation attached directly to that account. If the proper designation is missing, access to the funds can be frozen. Your family may then be forced to wait while the money passes through the probate process before it can be legally distributed. To understand why this system works the way it does, you have to return to the late 1960s. America's financial world was almost unrecognizable compared with today. Richard Nixon was in the White House, online banking was decades away, and for many families, a savings account meant a paper passbook sitting somewhere in a kitchen drawer or bedroom cabinet. At that time, many older Americans kept relatively modest amounts in savings, often enough to handle funeral expenses, unpaid bills, and a few final obligations. Probate courts were built around a world of smaller and more predictable estates. Assets could be reviewed and transferred over a period of months because financial life moved at a much slower pace, but the way Americans hold money has changed dramatically. The probate system, however, has not evolved at the same speed. Today, someone entering retirement might sell a home they have owned for 30 or 40 years and suddenly place hundreds of thousands of dollars into a high-yield savings account. What was once a simple account for emergency cash can now hold a substantial portion of a person's entire life savings. The balances sit in the hundreds of thousands of dollars. Federal regulations shifted. The Garn Street Germain Depository Institutions Act of 1982 changed how banks handle asset transfers, but state probate laws lagged decades behind. The legal threshold for a small estate affidavit in many states still sits at $50,000 or $100,000. If your bank balance exceeds that arbitrary number, the court demands full jurisdiction over your life savings. The judge appoints an executive, the state takes a percentage, your family waits. The delay destroys families. Let us look at a specific life. Dorothy turned 71 years old last October. She lives in Neepville, Illinois. In 1988, Dorothy and her husband Eugene bought a 3-bedroom split-level house on Maple Avenue. They paid $142,000. The house had oak cabinets in the kitchen and faded blue siding on the exterior. Eugene worked for the county. Dorothy taught 3rd grade. They lived a quiet, careful life. Eugene died of pancreatic cancer in 2022. The medical bills ate into their pension income, but they owned the house free and clear. 2 years after Eugene passed, Dorothy realized the stairs caused her too much pain. She sold the house on Maple Avenue for $415,000. She moved into a ground F floor or apartment near the library. She took $350,000 of the home sale proceeds and walked into the local Chase branch on Washington Street. She opened a standard savings account. Dorothy wanted to do everything by the book. She hired a local attorney and paid him $800 to draft a comprehensive last will and testament. The document clearly stated that all her worldly possessions, including the Chase savings account, would split evenly between her son Michael in Seattle and her daughter Sarah in Austin. She signed the will in front of 2 witnesses and a notary public. She put the document in a steel lockbox under her bed. She called Michael and told him she handled everything. She handled almost nothing. On a Tuesday morning in November, Dorothy suffered a massive stroke in her kitchen. She died before the ambulance reached the hospital. Michael and Sarah flew into Chicago O'Hare the next day. They paid for their flights on credit cards. They met with the funeral director. The funeral director handed them an invoice for $11,500. Michael knew his mother held $350,000 at Chase. He took the death certificate and the notarized will to the bank branch on Washington Street. He sat across from the branch manager. He slid the documents across the desk. The branch manager looked at the screen. He looked at the will. He slid the documents back to Michael. The manager explained that Dorothy never signed a payable on death form. Her account held only one name. Because the balance exceeded the Illinois small estate limit of $100,000, the bank possessed no legal authority to release the funds. The will meant nothing to the bank. A will is merely a letter of instruction directed to a probate judge. It carries no weight at a teller window. The bank froze the entire $350,000. Michael and Sarah walked out of the bank with nothing. They had to pay the $11,500 funeral bill out of their own pockets. Dorothy failed to understand the Uniform Multiple Person Accounts Act. She failed to understand Section 6-212 of the Uniform Probate Code. Specifically, she missed the law governing non-probate transfers on death. The banking system relies on a very rigid set of contractual rules. When you open an account, you establish a contract with the institution. If you die, the contract terminates unless you specifically name a beneficiary directly on the account documents. The money becomes the property of your estate. Your estate is a separate legal entity. It has no hands. It has no voice. It requires a living person to petition a judge for the legal right to speak on its behalf. This process is called probate. Many people believe a last will in testament bypasses probate. This is the most common and destructive myth in American personal finance. A will guarantees probate. A will forces your family to file paperwork with the county courthouse to prove the document is valid. The payable on death form, often called a POD form, bypasses the judge entirely. The POD form is a binding private contract between you and the bank. It supersedes the will. It supersedes the trust. It supersedes the probate court. The form costs absolutely nothing. The legal concept dates back to a 1904 New York court decision called the Matter of Totten. The court established that a person could hold money in trust for another without creating a formal legal trust document. Banks call this a Totten trust or a payable on death account. If Dorothy had filled out this one-page form, the bank would have handed Michael a cashier's check for $350,000 the moment he presented the death certificate. The transaction would have taken 20 minutes. People fail to use this protection in 3 specific ways. First, they assume the will covers everything. Second, they name a minor child as the beneficiary without designating a custodian under the Uniform Transfers to Minors Act, which freezes the money until the child turns 18. Third, they forget to update the form after a divorce or a death. If your named beneficiary dies before you do, and you name no contingent beneficiary, the account falls right back into the probate trap. One rare exception exists. Community property states like California, Texas, and Washington offer specific spousal overrides. In these states, a surviving spouse retains a legal right to half the funds acquired during the marriage, regardless of the name on the account. But this exception only protects the spouse. It does nothing for the children. It does nothing for the grandchildren. It does nothing for the widow who sells her home and leaves the money to her heirs. We need to look at the exact math of this mistake. Let us run the numbers on Dorothy and her $350,000. Because Chase froze the account, Michael had to hire a probate attorney in DuPage County. The court system does not operate for free. First, Michael paid the initial filing fee for the petition for letters of office. That cost $389. Illinois law, specifically 755 LCS 518-3, requires the estate to publish a notice to unknown creditors in a local newspaper for 3 consecutive weeks. The publication fee in the Daily Herald cost the estate $250. The judge required Michael to post an executive bond to ensure he did not steal the money. The premium on the shitty bond cost $1,000. These represent just the administrative fees. The attorney fees destroy the principal. Many states allow probate attorneys to charge a statutory percentage of the gross estate. Some charge an hourly rate that quickly reaches the same number. A standard fee for an estate of this size sits at 3%. The attorney took $10,500. The court required a full inventory of the estate, a final accounting, and a 6-month mandatory waiting period just in case a medical provider or a credit card company materialized to claim a debt. The court held the money hostage for 14 months. Add the numbers together. The filing fee, the publication fee, the bond, and the attorney fee equal $12,139. The family lost over $12,000. They lost 14 months of their lives dealing with a court docket, missing work, and filing paperwork. They lost the interest the money would have earned. They paid the funeral director on a credit card that charged 22% interest while they waited for the judge to release their mother's money. Now, let us run the second example. Let us change one single variable in Dorothy's timeline. When Dorothy sat at the desk to open the Chase account, the teller handed her a standard signature card. Dorothy asked the teller for the payable on death beneficiary designation form. The teller printed a single sheet of paper. Dorothy wrote Michael's full legal name, his social security number, and his date of birth. She wrote Sarah's full legal name, her social security number, and her date of birth. She assigned them each 50% of the account. She signed the bottom of the page. That signature changes the entire trajectory of her family. Dorothy suffers the stroke. She dies on a Tuesday. Michael and Sarah fly to Chicago. They walk into the Washington Street branch. Michael hands the teller the exact same death certificate. The teller looks at the screen. The teller sees the POD designation. The legal contract triggers instantly under FDIC regulations, specifically 12 CFR Part 330. The bank no longer recognizes the estate. The bank recognizes Michael and Sarah as the sole absolute owners of the funds. The teller prints 2 cashier checks for $175,000 each. The bank charges a $0 fee for this transfer. The probate court receives no filing fee. The Daily Herald prints no public notice. No attorney takes a $10,500 cut. The waiting period drops from 14 months to 48 hours. Michael and Sarah walk out of the bank. They pay the funeral director in cash. They go back to their own homes to mourn their mother in peace. This difference matters. It represents the gap between a family moving forward and a family drowning in paper. The system preys on ignorance. This happens to thousands of families every single week. The AARP estimates that billions of dollars sit tied up in probate courts across the country at any given moment. State treasurers hold massive swelling accounts of unclaimed property. Often this unclaimed property consists of bank accounts holding $10,000 or $15,000. The families walked away. They walked away because the attorney fees to open a probate case would consume the entire balance of the account. The state absorbs the money. In my 30 years watching this system grind people into dust, I learned one thing. Walter Barron cannot save you after the vault closes. You have to save yourself while you still have breath in your lungs. You have to look at the paperwork. You have to ask the right questions. You are sitting in your living room right now. You hold a checking account, a savings account, maybe a certificate of deposit. You assume your family knows what to do. You assume the bank will treat them with respect. The bank answers to the federal code, not to common decency. The traps run deeper than the checking account. Most seniors hold a safe deposit box at the same branch. They store the deed to the house, the physical will, the birth certificates, and their mother's jewelry inside the metal box. They hand the spare key to their oldest child. They believe the key grants access. The key grants nothing. When the bank learns of your death, federal regulations require them to seal the safe deposit box. Your child can hold the key in their hand. The bank manager will deny them entry. To open a sealed safe deposit box, your family must petition the probate court for a specialized order just to retrieve the will. This creates a circular nightmare. You need the will to open the probate case, but the will is locked inside the box, and you need a probate order to open the box. You avoid this by adding your child as a joint renter on the safe deposit box contract. You sign the document together at the branch. Seniors also fall into the joint tenancy trap with their bank accounts. They want their child to have easy access to the money to pay bills if they get sick. Instead of using a POD form, they add the child's name directly to the account as a joint owner. This creates an immediate, massive legal liability. When you add a child to your account as a joint owner, the law views that money as their asset. If your child gets into a car accident and someone sues them, the plaintiff can seize your bank account. If your child goes through a bitter divorce, their spouse can demand half of your savings in the settlement. If your child falls behind on taxes, the IRS can levy your bank account to pay their debt. The POD form prevents all of this. The POD form grants the child absolutely no ownership rights while you are alive. Your money remains protected from their creditors. The transfer only occurs the second your heart stops. Do not put your children on your checking account. Use the POD form. You must take 4 specific concrete actions this week to protect your money and your family. Do not wait until next month. Do not wait until you see your lawyer. Step 1 takes 5 minutes and costs you nothing. Walk into your kitchen, open your filing cabinet, and pull out your most recent bank statement. Look at the top right corner where your name appears. Look for the letters POD, TOD, or ATF. POD stands for Payable on Death. TOD stands for Transfer on Death. ATF stands for As Trustee For. If you do not see those letters, or if you only see your own name, your account belongs to the probate judge. Step 2 requires a trip to the bank. Drive to the branch where you opened the account. Walk up to the teller window. Do not use the drive-thru. Ask the teller for the Payable on Death Beneficiary Designation form. Every single FDIC-insured institution possesses this form. They must provide it to you upon request. Step 3 requires exact information. The bank will not accept vague designations. You cannot write "my children" on the form. You must provide the full legal name, the current residential address, the date of birth, and the Social Security number for every single person you want to receive your money. Bring this information with you written on a piece of paper. The bank uses the Social Security number to verify the identity of your heirs. Without it, the bank can delay the payout. Step 4 requires maintenance. Life changes, people die, people divorce, people fall out of favor. If your primary beneficiary dies and you fail to update the POD form, the contract fails. The money reverts to your estate. The money goes to probate. You must name a primary beneficiary and a contingent beneficiary. The contingent beneficiary steps into the primary slot. If the first person passes away, check this form every 3 years. Ask the teller to print your current beneficiaries whenever you visit the branch. Completing these 4 steps builds an absolute wall around your life savings. The banking system is built on routine. It benefits when people move through life without questioning the details, when account holders overlook the fine print, and when older Americans assume the rules will automatically protect their families. But one properly completed document can completely change what happens next. It can keep your savings out of a lengthy court process, reduce unnecessary legal expenses, and help ensure that the money you spent a lifetime building reaches the people you intended to protect. Tonight, take a few minutes and review your bank statements. Look carefully at how each account is titled and whether a beneficiary is actually listed. Do not assume that a will alone answers every question about how those funds will transfer. In the next video, we will examine the nursing home asset recovery look-back period, how it can affect a family's savings, and the types of trust structures commonly used in long-term estate planning. If you value clear information without unnecessary distractions, consider subscribing to the channel and leave your state in the comments. I want to see where these rules are creating the greatest concern for families. Protect the people you care about while these decisions are still yours to make. This content is provided for general educational and informational purposes only and should not be considered legal or financial advice.